One of the important issues when thinking about mutual funds or other types of portfolios is how to measure performance. And performance can be important for a lot of reasons. One reason is, for example, if you happen to be running a pension fund, you may hire managers to manage certain portfolios for the pension fund. You may have a fixed income portfolio manager, someone managing the bond portion of the fund. You may have somebody managing the growth stock portion of the fund, etc. And how are you going to compensate this person? Well, we want to provide some incentives, and we want to provide incentives for good performance. So we need to be able to measure performance. We need to be able to determine, how to rank this fund manager's performance relative to his or her peers. Another reason you might be interested in performance is if you're simply an investor buying a mutual fund, you'd like to know which are the best funds. So how do we compare funds? Oftentimes people look at return only. And the big mistake in doing that is that you're not considering risk. One of the basic tenets of finance is that in order to get greater return or greater expected return, you have to take on more risk. So a fund manager that has a high expected return or a high return may have taken a large amount of risk. So what we want to do is we want to incorporate risk and return together to get these performance ranking measures. And one of the measures, or one of the most popular measures, is the Sharpe ratio. The Sharpe ratio was derived by William F. Sharpe, Nobel Prize winner in economics, and perhaps more famous for his derivation of the capital asset pricing model. And what the Sharpe ratio does is it looks at the excess return of the portfolio. So it's looking at the expected return of the portfolio minus the risk-free rate. So it's the excess return over the risk-free rate divided by the standard deviation of the portfolio, or the total risk of the portfolio. And so you get this ratio, and essentially what this is measuring is excess return per unit of total risk. The higher the number, the greater the Sharpe ratio, and the higher the ranking. Let's see what this looks like graphically. The Sharpe ratio essentially plots the performance of the portfolios in expected return and total risk space, which it's basically comparing it to the capital market line. You can see right here in the middle I have the capital market line, and I have two portfolios, Portfolio A and Portfolio B. You can see that Portfolio A has a greater slope. It plots above the capital market line. Therefore, it's outperforming the capital market line. Okay, Portfolio B plots below the capital market line and is therefore underperforming. So if you were ranking A and B, A would be a better choice than B. You're getting more expected return per unit of risk you're taking. Okay, if you were to pick a spot here on the total risk axis and draw up, you would see that for the same amount of total risk, you're getting a higher expected return for A with Portfolio A than you are with Portfolio B. A second measure of portfolio performance is something known as the Treynor measure. And this was derived by somebody named Jack Treynor, who was a well-known person in finance, but spent most of his career in the private sector rather than the academic sector. And his is very similar to the Sharpe ratio in that it looks at excess return, okay, return of the portfolio minus the risk-free rate, so excess return over the risk-free rate. But the risk measure he uses is the portfolio's beta. It's systematic risk. So it's a measure of excess return to systematic risk, the risk you can't diversify away. And again, the bigger the number, the greater the excess return per unit of systematic risk that you're taking. And if we look at this graphically, it'll look very similar to the Sharpe ratio. In this case, we have systematic risk down here on the x-axis. So in this case, we're comparing our portfolios to the security market line, the capital asset pricing model. And again, in this case, A has a higher excess return per unit of systematic risk than portfolio B, so A would be ranked ahead of B. Okay, how do we compare these two? Well, let's think about it. Basically, the difference is that they use two different measures of risk. Since the Sharpe ratio uses total risk, it considers the degree of diversification of the portfolio. A well-diversified portfolio will have its total risk essentially equal to its systematic risk. The Treynor measure uses systematic or non-diversifiable risk, so it's better for you for evaluating a portfolio that's part of a larger portfolio. Okay, if the portfolio is perfectly diversified, then both measures are going to give us the same rankings. So let's see what this looks like. We've got a little example here. Portfolio A has an expected return of 12%, standard deviation of 6%, beta of 1.15. Portfolio B has an expected return of 13%, 7% standard deviation, beta of 1.5. And portfolio C has an expected return of 15%, 8% standard deviation, and a beta of 2.25. So if you were simply ranking on expected return, C would be first, B would be second, A would be third. And we also have a risk-free rate of 7% because we want excess return. And so I've done the computations over here, and it turns out that the Sharpe ratio for portfolio A is 0.8333. For B, it's 0.8571. And for portfolio C, it's 1. And then the Treynor ranking, or the Treynor measure, is 0.04435 for A, 0.0400 for B, and 0.0356 for C. So if we rank these, the Sharpe ratio ranks C first, B second, and A third. The Treynor ranking ranks A first, B second, and C third. So you can see that A and C rank differently because we use a different measure of risk to analyze these portfolios. Okay. A third measure for ranking portfolios is something known as Jensen's alpha. This was derived by Michael Jensen, and it's similar to the Treynor measure in that it looks at the security market line. It's the excess return, so if you think about this, this is the return of the portfolio, R bar P, and this is the capital asset pricing model, or security market line equation. So it's looking at how much the portfolio is ranked or is vertically above the security market line. And so if we look at a little graph of it here, you can see that rather than having lines coming from the risk-free rate, so we're not looking at a slope, we're looking simply at how much this portfolio plots above the security market line. And in this case, you can see A plots above the security market line, so it's producing an excess return per unit of risk. We can see that B plots below the security market line, so it's underperforming the security market line. It's underperforming the market portfolio. All right, the final measure of portfolio performance I'll talk about here is something called M squared. M squared was created by Leah Modigliani, who was an analyst at one of the Wall Street firms, and her grandfather, Franco Modigliani, who was a well-known economist, won the Nobel Prize in economics for his work in corporate finance theory as well as macroeconomics. What they do is they adjust their portfolio's risk by creating a second portfolio, which consists of the portfolio and some cash, and they want it to have the same level of risk as the S&P 500. So how do they do that? What they do is, if the portfolio is riskier than the S&P 500, they sell some of the fund, theoretically, and put the rest in treasury bills. If the fund is less risky than the S&P 500, they leverage up the fund by essentially short selling treasury bills or borrowing at the risk-free rate. So in this case, the funds are going to have the same risk, and then they're going to rank these based on which one has the highest expected return per unit of risk. So this is not as popular a measure as the other three measures, Sharpe, Treynor, and Jensen's alpha. In fact, let's take a look at that. If you go, I've taken this from Morningstar.com, and this is for CGM Focus Fund. This is a fund that invests in a fairly small number of stocks. It's not well diversified, and but here are the portfolio performance statistics. Now they put them in different places. All right, for the alpha and the Treynor ratio, they put that under MPT statistics, modern portfolio theory statistics, and you can see that they give you a couple of these. They give you best fit index, that is, they run regressions of CGM mutual fund against different indices to see which one has the highest R squared. And then they also do it using the S&P 500. All right, let's just focus on the one where they use the S&P 500 as the index to create the beta for their measure. All right, if we look at CGM mutual funds alpha, it's minus 12.5, so it's plotting well under its category. LB means large balanced funds, which means that large balanced companies. Okay, this fund buys large companies, and it buys both growth and value stock companies. Okay, the LB actually plots below the security market line as well. It's minus 2, but it's not nearly as large as the underperformance by CGM mutual fund. If you look at the Treynor ranking, okay, remember that the Treynor ranking is excess return divided by beta. Okay, they're both positive, but you can see that the category, okay, large balanced mutual funds, is much higher than the Treynor ratio. And then if you go down here, they put the Sharpe ratio under volatility measures, and you can see how they have the numbers here. CGM's Sharpe ratio is 0.26. Okay, if you look at the Sharpe ratio for the S&P 500, it's 0.87, which is better than the performance of CGM Focus Fund here. And also the category is 0.74. So this is a fund that's underperforming both the S&P 500 and its benchmark and its category of large balanced funds. So you can go to Morningstar, you can see these. If you were to look up several different mutual funds, you could then rank them based on their alpha, their Treynor ratio, or their Sharpe ratio. And this is a good way to determine, which funds are doing the best job of generating excess return per unit of risk.